Welcome to our seminar today, our webinar. We're going to be talking about how to increase the value of your business. We're really excited. We have Ashley Edwards here. We've got Esley Tan and myself, Aaron Abendroth. We're excited to talk about specific things. So we're going to be talking about EBITDA, what it stands for and how it relates to cash flow. And then we're going to also be talking about strategic working capital, um, then streamlining operations, strength of the balance sheet, and why that's important, and then mitigating risk. We'll also be talking specifically about intangible assets and how to identify them and to keep track of them. But one of the things, as we're just going through this, I just want to introduce myself. And my name's Aaron Abendroth. I've been working with Haynie for uh, almost 14 years, 15 years. So, and I am a CPA. I've been dealing with valuations and everything related to creating value within the business. I'd like to have Ashley introduce herself and then also Esley.
Thanks, Erin. So I'm Ashley Edwards. I'm a business valuation manager here at Haynie Company. I've been with the firm about 3 years, and I have actually been doing solely valuation work for the last 6 years. And I'm a CVA, so that's a certified valuation analyst. It's a little different than the most of the CPAs we have here at the firm. And so, anyways, I'm just excited about this topic today. I think getting to the heart of how we can help business owners learn to work to increase the value of their companies is something we hear about all the time, and we know it's something that a lot of entrepreneurs are going through and trying to accomplish. So I'm just excited for the topic.
Yeah. And then I'm Esley Tan. I am a CPA and a CVA. I've been with Haynie Company for about 4 years now, actually. Couple of years in audit and about 2 years in valuation as well. And like Ashley said, I'm just excited to talk about this topic and how we can help you business owners.
Well, thanks, guys. And I'm really delighted to work with both Ashley and Esley. We work as a team and we're excited about what we do. So that's one of the things to kind of take a look at. But just diving into this and getting into it, let's go into EBITDA and cash flow. Um, EBITDA, you hear this word, EBITDA. What does it stand for? First of all, it stands for earnings before interest, taxes, depreciation, and amortization. And, EBITDA is, you have to know first of all, how to calculate it. So you go through the process of calculating the EBITDA because that's uh, the first step in understanding how to use it and how to create more value within your business so you can track it. Now, one of the things, EBITDA does not mean cash. Okay. Cash flow is we're dealing with how much cash do you have in the bank, how much is coming in, etc. But we go through the whole process of helping to calculate EBITDA, and then cash flow is something different, and you have to look at that differently than EBITDA. And that's why we say here, a strong EBITDA does not guarantee healthy cash flow. But now what we're talking about, the EBITDA, will help you to actually create more value. So as your EBITDA increases and you concentrate on, hey, here are some things that we can do to increase our EBITDA. Then when you come to a given point that you want to sell, combine, do whatever you want to do within your business, it creates more value for your business. And EBITDA is also including, if you can see, capital expenditures. Okay. That's no matter what, EBITDA does have to take into account, but we're we're going through the process of calculating EBITDA and also helping on your capital expenditures. So those are some of the things. But with uh, you know, as we're looking at EBITDA, it's uh, it's something that we have to take account and we have to go through the process of accounting for this. So anytime you're looking at trying to estimate your value, EBITDA is one of the first numbers that you go through. So Ashley, can you tell me some things that you're looking at when you're looking at EBITDA?
Sure. Well, so it's an interesting thought because we talk to so many business owners who are so focused on that EBITDA figure, right? Most of them, if I ask about actual net income, they won't even know the answer to that one, right? Because they're focused on EBITDA. It's stripping out the taxes and the financing decisions, and then some of that non-cash stuff as well. It's stripping all that out so they can really focus on what they're actually doing operationally. And EBITDA is such an important figure, but then ultimately cash flow is king, right? So Aaron touched on that a little bit. They're not one and the same. And when we're thinking about the cash flow, that's when we're thinking about all of the other places that cash has to go at the end of the day. And it's, the cash left after EBITDA isn't just what's necessarily getting distributed to any owners, right? There's other things that are going to happen. So those financing decisions and servicing debt and capital expenditures and maybe even putting more working capital into the business. And so just reinvesting, right? There's a lot of places that cash can quickly disappear to depending on the decisions that an owner is making for the business. So the higher we can get that ending cash flow number, the more value creation you have. So EBITDA is a really important figure in getting there, right? Controlling our costs and thinking about those things, growing that EBITDA figure, and then that leaves you more left over for the cash flow figures as well. So doing that in tactful, strategic, and smart ways is really key. And for a bare minimum, right, from a financial aspect, a great starting place to work on growing the value of the business, which we'll talk more about what that looks like as we go. But that's kind of an opener on kind of the key importance on each of those and how they work together.
Okay, with that being said, what do we do to maximize EBITDA and cash flow? Okay. And one of the things that, as we're looking at this, we have to go through the process of looking at your operating cash flow. Okay. Free cash flow. Now, how is that different? Esley, why don't you kind of talk about the difference between free cash flow and operating cash flow?
Yeah. Yeah, so operating cash flow is the cash generated by your core business operations. So this indicates sustainability and the ability to generate cash from your daily activities, whatever your core business is. And then free cash flow is whatever cash is remaining after capital expenditures um, are taken out of your operating cash flow. And so this indicates your ability to reinvest in the business, reduce debt, or pay dividends to your shareholders.
Yeah, so that's important to kind of understand the difference between operating and free cash flow. There's also some other metrics that we can look at, the cash flow margin. Um, and as we're thinking about the cash flow margin, what are we talking about, guys?
You're talking really about your operating cash flow compared to your margin, right? At the end of the day, that's a really important figure. How effectively your business is going to be converting sales to cash.
Yeah. And that's the key. And actually calculating it and then tracking it. Because one of the things that you can see over time is that these particular uh, uh, metrics will be changing. And as a result, you can actually not only increase the value of your business through tracking it, but also predict when you're going to need greater cash or loans or capital that's needed in your business. Also, one of the things, if you look at cash, you got to look at your days sales outstanding. We're talking your collections. This is a time when you get Greedo to do some of your collections, if you will. So it's one of those, the days sales outstanding is one of those calculations, and that's really talking about receivables. The days payable outstanding is how long are you paying your creditors and your vendors. Those are two important numbers, and a day or two adjustment in either direction could mean a significant cash flow adjustment to your business. And then we have inventory turns. Esley, tell me about inventory turns, how that affects cash flow.
Yeah, so inventory turnover is just how many days it takes to sell all of the inventory that you have. And so having a lower inventory turnover, having having a higher inventory turnover rate. Sorry, wait, I'm getting
You want quicker. You want
yeah,
quicker
I'm getting a little
inventory turnover, right? That's the goal at the end of the day for most businesses, and per industry, what that's going to look like is really going to vary, and that's okay. But it is important to know if you have inventory in your business, what that looks like in your industry, what a normal range would be considered, to make sure that you don't have too much, too little, and make sure you're operating from a really good place, right? Versus a struggling place. So all of these metrics at the end of the day, they're just great key tools. You can just Google them and get formulas, and you can apply these on a regular basis to make sure that you're keeping track and that you know kind of where you should be sitting. And you can also get some industry information, right? So see where you're sitting, see where others in the industry are sitting, and see if those things align. And if not, seeing if there's changes that you can implement, right? To start improving some of your metrics to where you want them to be, to get in line with or better than industry, right? All of these things will help you. Not only is it going to help from a cash standpoint, but it's going to help from a value standpoint, right? The better all of these things are, the higher multiples we can start talking about when you're talking about an eventual sale or something like that.
And one of the things, as you're thinking about these metrics, also conveying to your team members, hey, we're tracking these things, and it helps to get them on the same page operational wise. And as a result, they will be the people that will be helping to actually make sure your inventory is turning, make sure that you're receiving your receivables. And so as you're thinking about these things, maximizing your cash flow is going to be the number one thing that will actually mean more value to your business. And as a result, that's one of the things to consider as we're going through this. Uh, Moving to the next part, we're
Yeah, I
going.
think we could talk about that all day. But another really key thing is strategic working capital management. So that's another really important piece of evaluation, because efficient working capital will ensure that there's cash available, right? Because then we start talking about not only operations, but the financial stability. So making sure that we have enough working capital available to make sure things are running smoothly is another really important piece. So Aaron, what would you say is why is working capital management so important for both liquidity and value in business?
Working capital is absolutely critical, because if you don't have the working capital, you will not be able to provide either the service, the product, whatever your business is doing, to your customers. And as a result, not having working capital means you don't have the inventory. You have no ability to actually take care of your customers. And that's what it ultimately gets to. And also, another thing, working capital is your current assets minus your current liabilities. So we're talking about things that are very much, you're dealing with them day by day. And it's really critical, as you've got to have cash, you've got to have the ability to take care of your team members too. You've got to take care of and go through the whole process of making sure that if I have capital, working capital, I'm actually running the business. If I don't have working capital, you're dead in the water. And that's what a lot of businesses generally, if their working capital dries up, that's a huge problem. And as a result, but
Yeah. It signals liquidity, right? At the end of the day, it signals liquidity. It signals that are you have operational discipline, and ultimately it's converting revenue into cash, right? Without that, you can't do that. And some businesses require more than others. Esley, what about you? What do you think is a common mistake you see that businesses may have when you're looking at their working capital? Do you think it surrounds their inventory levels, their collections, their supplier relationships, or I should say maybe loose terms with their suppliers?
Right. Yeah, usually the biggest mistakes we see are slow collections. So having your accounts receivable out for too long and not collecting those sooner, or having a bloated inventory. So um, just buying too much inventory and stocking up on it when it's not necessary, and your inventory isn't flowing through as quickly as you think it is. And so both of these trap your cash that could be reinvested elsewhere, which decreases your chances for kind of building growth within your company as well.
Yeah, I think that's a really good answer.
Mhm.
Okay, so what's next? Streamlining operations. Who wants to take that one?
Yeah, I can take that one. So streamlining operations is just trying to improve your operation so that you don't have to think about too many things um, going on through your business. And so the best way to do that is to find hidden inefficiencies. Um, Ashley, what do you think is the best way to identify hidden inefficiencies within your daily workflow?
But I think one really good way is to engage your employees in that conversation, right? If you're not like a one-man team and you've got people, I think a really good way to figure out and to find your inefficiencies is to see where people are struggling and what they feel is moving slow, because they've got potentially some great insight that you may not see on a day-to-day basis. So I think that's one really, really good way to start finding those efficiencies. And we're talking about, maybe basic things, processes, procedures, documentation, kind of those operational things that can be time consuming to set up and sometimes we don't ever get to doing, right? As business owners, that takes time to work on the business versus in the business. That's such a favorite phrase of mine. But anyways, I think that's a really great place to start, is asking your people, where do they see inefficiencies? What do they think we can improve? Do they have ideas on how to do that?
Mhm. Perfect. Yeah.
what one idea that you can have for inventory is how you actually set up your warehouse. And are you doing staging of inventory for the day's work? And so there's different things that, that process mapping really works well if you, uh, like Ashley said, working on your business. It takes time to do all of that. It's not actually doing the day-to-day work, but you're looking at overall and going through the process of saying, hey, this is how we do things. How can we do better?
Mhm. Right. And with that process mapping, you can document how work actually gets done. And so you can figure out any bottlenecks, any redundant steps, or any manual work that doesn't really add value to your operations and just streamline those better, right? Even finding like small fixes like automating reporting can have a big payoff in your operations. And then next we can talk about efficiency and technology. Ashley, have you seen any how AI can make a real difference in operations and all of that?
Yeah, a lot of people are starting to really use AI, and it doesn't have to be too complicated, right? You can get more complicated with it. That'll take more time and effort if you want to really use it very intentionally and heavier. But that also, like I said, takes a lot of time. It also makes people nervous. There's a lot that goes into doing that. But at a bare minimum, you can start with using AI in a really simple way with email automations. That's such a good tool. Let's see, having it help you with reporting. We have it on the slide. So reporting, invoicing, scheduling, just really basic things that are simple that you can trust. You can get it set up the right way and not have to be concerned about what the output is going to be for there. But then we see people getting more intensive with AI too and really saving money. But there can come a cost, right? For the amount that you want to automate. I mean, you see like in grocery stores, there's not cashiers anymore. It's not the same as AI necessarily, but there's a point where technology can kind of potentially take over culture. And so you got to balance that line if you're a business that you need people there, and you want to have people there and you want people to stay with the business if you're ever to exit, those people and that knowledge that they hold, those things create value too. But AI is a helpful tool in helping make sure that you can streamline and free up their time a little bit more at minimum in a very simplistic and easy way. That's a long answer.
And one of the things about AI that it just takes time for people to first learn how to use it, and then secondly, how to not use it too. Because there's times that you don't want to have AI do something. Then I find it really interesting that how our world has changed so drastically in just a short time frame. So anyway,
Yeah.
that's my thoughts. AI is scary but wonderful at the same time.
Mhm.
Yeah.
Okay. Let's talk about strengthening the balance sheet to attract investors and support growth. A strong balance sheet is vital to the success and growth of your business. It not only reflects your financial health, but also enhances your ability to attract investors, secure favorable financing, and position your company for long-term success. Um, and so, Aaron, what are some balance sheet indicators that give investors the most confidence?
Yeah. The number one thing that I look at a balance sheet and investors are looking at, they're looking at your working capital, taking your accounts, essentially your cash flow that's being created, the working capital, saying current assets minus your current liabilities. That's a very important metric that people will look at. They will look at also how much your receivables, how quickly your receivables are actually being collected. And that's a combination of both your balance sheet and also your sales. That's a really simple calculation to go through, but there's there's the working capital, there's I look at the receivable capture, the other thing that no matter what, they're going to look at equity versus liabilities. I mean, are you highly leveraged? Do you have too much debt?
Yeah.
And that's an important aspect. And there are some industries where it is expected that there's a lot of debt, like the trucking industry. That's one it's high assets and high debt. And then but a lot of times what you see also in your balance sheet is that you've got to look at cash. Cash is king, no matter what. And one of the things that you want to show on your balance sheet, especially when it comes to year ends and different things like that, you want to have a strong cash position. And that's what I see. You know, the the high debt, also just returning to that, the high debt aspect is it makes investors very, very hesitant because they're saying, okay, why is the cash flow not being controlled well? And
Yeah.
that's key.
Yeah, I just want to add to that too. So Aaron mentioned some industries maybe that are asset heavier or asset intensive. They may have higher debt levels. It'll depend. So that's again something I would encourage all business owners to go find out what's happening in your industry. And even if you're in more of a niche position, you can find something that operates similarly to yours, even if they don't do exactly what you do. So maybe they're more service-based, maybe they're more asset-based. So I would find something that operates similarly and try to get a good understanding of what those debt levels should be, because there is a difference as well between having strong liquidity and some debt, strong liquidity, no debt, poor liquidity, no debt. You can have a whole variety of situations, but debt can work for you and for the business growth. So debt is not necessarily something to be scared of, but it also is important that it's manageable, because someone buying your business, they are looking for a return on their investment at the end of the day. So if the debt levels you have eat up all that remaining cash, then there's no money going back in their pocket potentially. So it does really come down to those things. Those things are important. Those things and healthy reserves as well, I think are another important thing. So just something to add, food for thought.
And one additional thought is that as you're looking at the type of debt that you take on, and there you can arrange debt to be serviced in many different ways. So don't be afraid to explore those options with your banker, investment people, bringing in private equity, different ways of trying to get capital. Because one of the things that you have to also take a look at, having 100% of a business, you've got a lot of risk in it. So a lot of times people will look at trying to say, hey, I might want to sell a piece, so I'm not taking on all of the risk. So that's one of the things to consider as you're looking for growth, because your balance sheet will actually help you grow the business. But a weak balance sheet will definitely hinder your growth.
Yeah, so on the next slide, some key strength indicators are having a strong current and quick ratio. Current ratio is just current assets over current liabilities. Quick ratio is pretty much the same thing, but you take out inventory and divide that by current liabilities. Typically having a ratio above 1 is usually pretty good, but doing some industry research to determine what other companies in your industry currently have for their ratios is a good way to determine where you are within your industry as well. Um, and then Ashley, when's a good time to build reserves versus reinvesting in your business?
Uh, having strong reserves, I think I just mentioned that it
Mm.
ensures it creates resilience, right? You have the ability to fund things if you need to. But I think good times for reinvestment. I think when you have extra cash flow, is a great time, right? Instead of taking all those distributions and putting it out, giving it out to yourself, if you want a bigger cushion, that's the time to do it. Do it while you can, do it early if you can. That's not always the case. You want to balance, the distributions that you're taking or what you're taking left over of the cash. You want to balance what you're keeping personally, because that's important too. But that's a great time to just start focus on building those reserves for that more long-term stability, so you can weather those downturns, right?
You
And
know,
then having, yeah,
how one of the things that we kind of look at too is, okay, how much reserves do you want to have? Is it 1 month, 2 months, 3 months, 6 months? It really depends upon the industry. I mean, some of the best and most profitable businesses out there, um, they they have sufficient cash ready for investments, and they take uh, by having the cash and the reserves there, they can go through the downturns, but in addition, they can take advantage of a lot of different opportunities that come. So,
Yeah, I think that's a good point. I'm working with a construction business right now. Leslie and I are, and the business that this individual has created is pretty incredible. He's a pretty large business, very middle market size business. So he's doing really, really well. And in construction businesses, it's so common to need such a big cushion and such a large amount of working capital because there are delays in payment and it takes time, and you may be funding things up front and versus getting paid up front, right? So his business is structured in a way where he's getting paid usually within, I think, about a 14-day window. And he doesn't have to have that same level of cash reserves in his business. And so Aaron made a good point, like how much do you actually need in this working capital reserve, right? Or how much do you need sitting there in actual cash? And versus what is going to be in excess. Because when we are talking about business value, you don't necessarily want a ton of excess sitting there all the time. Because if you have that in terms of a business valuation, that excess cash is something that we add back dollar to dollar to the business value, but it signals something that you would be keeping yourself. But you don't want that excess sitting there unless it's being well invested and you're using it to your advantage in that sense too. So.
and I think we can move on to the next slide for mitigating risk.
uh, one thing though, on that last, it talks about having good management. Okay. And management is more than just the owners. And as you're looking at trying to increase the value of your business, one of the things that can help to increase it and also to make your life better is that you've got people that can run the business when you're not there. And as a result, businesses that do have that in place, good management and good processes, those are important for demonstrating that there's value in the business. So if the owner leaves, hey, uh, business continues. Anyway, so sorry.
No, I think that's a great transition into our next section, which is mitigating risk. So that's a really, really good transition because that is one of the most common things that I think that we see business owners go through is that it's this top guy and maybe this one other top person. and finding a way for one or both of them, maybe two owners, to be able to exit and know that things are going to run well and efficiently. So having a well-balanced team, one that you have given permission to go and try and fail and succeed, right, will help you get there. But having those key individuals is a really important thing in mitigating risk in a business. It's truly, I would say, I don't know if you two agree with that. I would say that's
I
the
do.
biggest thing we see all of the time for our smaller privately held businesses where somebody's ready to retire, right? I mean, that's what we see constantly. So if you can work really hard to get the right team in place, maybe let them invest in some way, shape, or form, potentially even to get them really invested and they want to stay, that can be a great strategy as well.
Yeah, and and that's the key on all of this, is that there's a continuation of the business, and that's mitigating risk and protecting your business is, I mean, no one will protect it like you as the owner, no matter what. And as you're looking at this, you're also going to want to make sure your business has diversity in its customer base and vendor base. I mean, a lot of people understand, hey, yeah, I don't want all of my business with a customer, but let's take the example of what happened to Ford last week. One of their aluminum suppliers had a huge fire. Well, they're saying that this is going to affect Ford's supply chain for aluminum for several months. Now, that's something that they're dependent upon a specific vendor, and to see such a big uh, uh, dependency, that's a bit scary for a potential buyer or investor of a business. So, those diversifying and taking a look at your business and saying, okay, what percent of my business is coming from this customer? What percent on the vendor? I mean, those are things that, as Ashley has talked about, working on your business, not in your business, that's an example of something that you want to do. Also, I mean, how many times have I'll just give this example of, it talks about the next review contracts regularly. Okay, well, that's important, but also that's related to pricing. For example, if you're displaying pricing on a website, or if you're displaying it on billboards or different things like that, making sure that your pricing and such is all consistent, that you have the right pricing and the right contracts in place. Those are different things. I mean, if you're uh, for example, Ashley, uh, what have you seen to help that people do to train for, um, just if a person is cross-functional, and why would that be important?
Okay. Well, I think most people are aware of cross training an individual, right? I think that can be a really key aspect of what your employees do. But you're, again, if you don't have individuals cross trained within your business who are able to take on multiple things, you're creating some risk there that if something happens to that person, maybe they get injured and need to go out, have a baby, right? I mean, there's all kinds of things. You're creating this gap if you have a smaller team. If you have a larger team, maybe not as much of a concern and easier to fill a certain person's shoes, but it's not always the case with a lot of entrepreneurs that we're working with, right? It can be a smaller team, and if any one person goes out, we can have some real problems operationally. So making sure that people are cross-trained is a really big thing. And I do want to back up on something, because I think we maybe could have started this section off a little differently. I want to tie this to how it is going to impact business value at the end of the day. if you're selling or if you're getting a business valuation or gifting or whatever you might be looking to do with your business eventually. When we're talking about mitigating risk within your business, yes, if you have done those things, it'll result in a higher value, but I just want to mention how. So when we're doing a business valuation, there is something called company specific risk. And it essentially the amount of risk percentage that gets applied to your business, which is based on a lot of these things that we're talking about. The amount that we decide gets applied, which is very much a professional judgment call. I mean, it's educated, but it is a decision that we as valuators are going to make based on what we learn about your business. That is going to, the higher that number is, the more risk we think you have, it's going to discount all of the value of your cash flows, and it's going to give you a lower business value. Or maybe it will transition to a lower multiple if we're really just looking at market data, right? You may not be worth as well, you won't be worth as much if there are significant risk factors in your business. So I just wanted to mention that is how these risk factors are important, because they tie into overall value. They tie into what you will get in a deal. And not even just from a number standpoint, like what we would do in a business valuation, but from the standpoint of who might be looking to buy it and what might scare them off. So anyway, sorry, we can keep going into the resilient section, but I did want to mention that.
Great point, Ashley. Great point. Okay. One of the things, just it's important as we're talking about value and such. We talk about intellectual capital. When a person or a process is important to the business, okay, we want to continue to keep that intellectual capital. And that kind of puts us to the next part, which is with intangible assets. Now, intangible assets. Ashley, tell me what we're talking about there. What's an intangible asset?
So intangible assets are things like patents, trademarks, client agreements, things that you don't physically have, but they do create value for your company.
Yeah, and it's key. Intangibles are, you can't touch it, right? So, but it's there, and it's probably the number one thing that really does create more value within a business. I mean, we can talk about brand awareness, client relationships. We can talk about trademarks, patents. Patents, very important. And that's one of the things that I don't know if there's any attorneys on this particular webinar, but the use of patents is critical when you're dealing with a lot of different things. Also, one of the things, taking a look at when we're looking at the value of the business, we're looking for these things. We're looking for the trademarks. We're looking for the patents. We're also looking at how you're defending them. That's one of the things when we're doing evaluation, that it's pretty important that the patent is updated, and as a result, we're going to look at when you actually got the patent and when it expires. And when it expires is an important aspect. One of the things, Ashley, can you tell me about some of the best patents that you've had to kind of work with that have increased the value of a business?
I think we had some really, really good ones tied to software. And obviously the revenue driven from what is tied to those patents has been a key piece of that as well. But you've got the patent aspect, and people obviously generally kind of tend to value very tangible assets, and they do sometimes are very, very aware of the intangibles, but don't also really have an idea of what they're worth. But that can be a really key part of it. And it's not just patents either. I think we see patents a lot more on the IT side or innovation side, right? The more technical side. And sometimes we see IP in a sense that we don't really necessarily consider IP, but a business owner might consider IP. It just may not be treated separately for valuation. So we honestly see a little bit of both. But then there's also things like your brand reputation, and that's a big one. There's all these other aspects, your employee expertise that you have. There's all these other aspects that tie in, and it's not all about necessarily these intangibles. It's not all the patents, right? But it's also all the goodwill created from all of these different aspects working together, and that can truly end up having a significant amount of value in the right situations.
And one of the things, as we're, talking about intangibles, a lot of times they don't show up on your balance sheet.
Yeah.
They really just don't. But when we're looking at valuing a business, it's key that you identify in your own mind what intangible assets that I have. And that's, we can talk about you document your client contracts. You can also make sure your patent defense is, and that you're paying for your renewals and everything like that. And that's all good, but the number one thing, if you're going to try to increase the value of your business, you're also going to list out all of the other intangibles, customer loyalty, etc. One of the things that you can look at, you can also look at strategic partnerships. Maybe you've got specific people that you work together with. A classic example would be a general contractor and a subcontractor. Maybe there's a cohesive team of that partnership. And that's something that you can actually look at and document this and uh, keep it in mind when you're trying to increase the value of your business, or or you can look for those strategic partnerships. One of the things that's important is the R&D. Esley, tell me about R&D a little bit. How does that help a business?
Yeah, so R&D is research and development, and having R&D means that you're showing forward momentum, right? You're trying to find something innovative or investing in something for your business that will help potentially in the long run and in the future. Um, and so buyers see R&D as a proof that the business isn't standing still, that it's investing in relevance and uh, working to be still relevant in the future and to keep performing in the future.
And for those who aren't aware, the R&D does have some tax benefits. So that's a way that you can show that you're trying to increase the value of your business and also get some tax benefits out of it. So it's a good thing all around. But those are the intangibles are, uh, as it says, the invisible multiplier. It can take a
Yeah.
business that, if you look at the balance sheet, and balance sheets are just listed on historical cost, okay? But it can, let's say the historical cost is in 1980. Well, the value today is significantly different than in 1980 historical value. So that's what makes the invisible multiplier. But
Yeah.
Yeah.
I just think intangibles get so often overlooked by business owners. And so it's such an important thing because ultimately buyers love predictable cash flow. They love knowing that that is going to be coming in. And part of your intangibles that you can work on as a business owner is creating those things that you know is going to generate predictable cash flow. So maybe that is client lists and the length of time you have these clients and relationships. Maybe that's true contracts that bring in recurring revenue. Those kinds of things that you can think about and work towards if you don't already have them in place. They may not always have a separate number or a value as you're coming up with a deal price, but they'll be part of what somebody is willing to offer. And like Aaron said, it's your balance sheet it's the 1 + 1 = 5, right? That's the rule. 1 + 1 = 5 when it comes to intangibles. And so you might have 1 + 1, but you're getting offered a 5 because you've got all of these other aspects that make a buyer say, this is it, right? This is the good deal for my return of my investment. So it's just such a big piece of the overall deal structure. So the more you can put in place, the better off you'll be, even if it's not more intensive things like patents and things like that. It can be the more simpler side for a lot of businesses.
And one intangible asset that uh, I've learned, I think we've all kind of learned when anytime we've been in a business is an assembled workforce. A workforce that's actually working together. That everyone knows, hey, I've got to do this, and they know what to do to get the job done. And so those are a lot of different things that come into play when we're looking at the value of a business. So, and that's we'd like to unless you guys have anything else, Esley and Ashley, we can
No,
open
we've got
up.
time for the Q&A.
Yeah, we can do
So
this.
we have a chat box, and I think there's also a Q&A box. If anybody has questions, feel free to put them in there, and we can talk about it. While we wait, maybe for some people to put some questions in. Sometimes we get great questions. Other times the group's not quite as chatty. But in the meantime, Esley and Aaron, what would be one thing you would say the business owner could start doing right now? One change they could start doing right now, tomorrow, to start increasing the value of their business.
Go ahead, Esley, you go first.
Yeah, I was thinking just start to track your cash flow and your working capital and just working on ways to improve those and see how you're performing against the industry as well. I think that will help a lot in increasing your value and getting a better feel for your business if you don't already have one for it.
I think that's a really good point. You can't improve something that you don't know where you stand, right?
Mhm.
We do have one question. It just said, can we have a copy of the slides? Yes, we will
Yeah,
send
I
out
was
afterwards. I think we maybe forgot to say that at the beginning, but we will send out, I think the full, maybe the recording, maybe not, but definitely a copy of the slides will be in there.
one thing that I would say to business owners, and I really like how Ashley concentrates working on your business versus in your business. But take an afternoon every week and really work on your business. I think and work to say, I want to increase the value of the business and create the purpose. Visualize why you want to do it, and then spend that afternoon every week.
Yeah, that's really good. Pre-planning it is having it the time set aside and ready to go is always such a key, and in general, how individuals can run their business. But when it comes to working on it as a whole, I think that's a really great tip as well. We have another question. Aaron, I'll put this one to you. What professionals can a medium-sized company use to document workflows? Can you advise on technology or professionals that can be hired, where you find them to help with this?
Um, I'll, some of the technology that you can use a ERP system, and that's essentially a ERP system is a way that you're looking at your process of inventory, different things like that. Um, uh, as you're, and then also uh, for that type of business, it really depends upon the industry that you do have.
Yeah.
But I'm trying to think of specific uh, workflow type of business software products that you can use.
I would say what you should research is workflow management software or workflow automation platform, something like that, right? Because I think you made a good point. There are a lot of different ones out there. There's a lot of different price points, and there's ones that are going to work better for service-based industries versus other type of companies. So I think doing a little research there would be good. But I do know there are also professionals who do specialize in that kind of thing, that you could hire someone to come in and help you do that. I mean, I think Haynie, we have someone internally. I think that's how we got her. Is they hired her to come in and do that. Now she's a full-time employee. But anyways, I would say if you research workflow management software, that's a really great starting point. Because like Aaron said, there's just a lot of different options out there, and we don't know much about your business or what would work best.
Uh, One of the things to when you are looking at it, uh, a good resource would be to go to like an industry website. If you're part of a industry specific group, that's a great example, a great resource to kind of leverage.
We have another question, which is going to be a taxes question, I think, Aaron. So our development team has transitioned over to creating AI tools for the company to manage process and monitor clients. Can that still be considered R&D?
Um, there are specific, generally, yes. If you're looking at it from the concept, you are developing something that you're taking on risk. You don't know if it's possible. And then also, can you track it? Okay, how much you're actually investing into your R&D, you have to track it. A lot of times people will use like billing codes when they're recording their timesheets, etc. Or, but you do have to go through the process of you have to take on risk. You don't know if it's going to happen. If it's technology based, and then also you have a way to identify those particular costs. And you're talking mostly with payroll costs. And then if you're using subcontractors or materials that are specific to the actual R&D process itself.
Okay, that's good. We've got another one. Don't, don't, let's see. I think she's trying to just ask, when talking about multipliers of profits to determine a business valuation, what do you use? What's a common multiplier? So the most common multipliers for a business with decent cash flow is going to be an SDE multiple and an EBITDA multiple. Those are the two. The difference between them is your EBITDA multiple is what we've talked about before, right? It's your operating profitability number, stripping out your interest, taxes, depreciation, and amortization, those non-cash things. That multiple is a really big one that buyers will use a multiple to determine a price that they're willing to pay. And then the SDE multiple is called seller's discretionary earnings. This is really, really common in smaller businesses with one or two owners. And what we're actually doing there is we're taking that EBITDA figure that we got to, and then we're adding back any owner's compensation. So let's say your EBITDA figure is 500,000 and your owners are, you have two owners and they're taking 150 each, right? And we're adding 300,000 back to that. So then our starting point becomes 800,000 and we're applying a generally slightly lower multiple than what that EBITDA multiple is. But if you're taking a decent amount of compensation, your owners are, then that should pay off to use that slightly lower multiple because you've got a higher baseline figure that you're starting with. Do you have anything to add to that, either of you?
Just one thing to add, when you're dealing with multiples, and the potential buyers come into play because there's, if you will, Joe Schmo off of the street that's looking to buy a business itself. There's a multiple there. However, when you're doing a strategic sale or purchase, a lot of times that multiple is actually on the higher scale because you're taking out some of the overhead because you've identified a way to make it a strategic purchase where it might be they're buying the sales or
Yeah.
the customer base, what have you.
That's a great point. So that's all the questions we have, and I think we're actually out of time for today. So thank you everyone for joining us. You will get an email with details on the webinar topic today. But if you have any questions, I think we've got one more slide here that we can just show. It has our contact information. If there's any kind of conversation that anybody wants to continue or have questions, and then we've got some recommended reading as well for entrepreneurs in the situation of trying to grow business growth. But otherwise, thank you for attending.
Thanks, guys.
All right.